Financial Partners. Alonso, thanks very much for joining us. First of all, when you're trying to measure volatility in the market, what generally are you watching?
John, good morning. It's great to see you again. So, and this market is keeping us very, very busy. We're watching, obviously, the VIX as a measure of volatility. When we look underneath the surface, the market, although it has felt very, very volatile, it's felt very choppy, the rest of the market, aside from consumer discretionary and technology, has done okay. When we look at financials, we look at healthcare, we look at consumer staples, the market has done generally okay. There's so much concentration, John, in those big mega cap tech companies that we've seen a little bit of a repricing and a sell-off, and that spooked a lot of investors. We're looking at the consumer sentiment and bull bear sentiments, and the market is very, very bearish at this moment, and that's something that we're seeing today as an opportunity, and we did last week as well.
Okay, so you're saying when you look at a large part of the market that has less to do with, AI this and AI that, there's some good trends you're seeing, and that prompted you to be buying or bullish on the market.
We even saw, a lot of investors pushing into safe havens. I know gold pulled back a little bit from those all-time highs, but Treasury, specifically that long end of the Treasury curve, yields move lower. And so investors are active in this market, tactical. There's so much news. I mean, we get whipsawed. Last time, John, you and I spoke, we had tariffs on by morning, and by lunchtime, the tariffs had been extended. And this week, we get a slew of economic data. And, the unemployment data, we get ADP, we have a joint session of Congress tomorrow, as well as the Bitcoin summit on Friday. So this is a very busy market, and investors have the opportunity to be tactical still in this market.
Yeah, I'm glad you mentioned jobs numbers. I mean, at the end of the day, the jobs markets in both Canada and the United States have held up relatively well. And I do wonder if that's, on the economic numbers that you're going to be watching, because there was so much focus increasingly on some of the confidence readings in the U.S. I'm personally not surprised to see confidence numbers taking a hit given the headline uncertainty. But the question is whether or not people are still gainfully employed, because that's obviously a determining factor for the economy.
See, the last unemployment rate that we got was 4%, and that's generally pretty good. I think as we watch how these developments play out at the federal government level, folks coming out of employment at the government level, we'll see. The unemployment rate maybe ticks up a little bit, but overall, when we look at the macro data, pretty supportive of a generally strong economy. There are a lot of headline news, and we're just going to have to wait and see how this plays out. It's possible that by the time we get to tomorrow, there's another extension, or maybe the tariffs don't actually go into play. And ultimately, when we look at this market, the Fed still has a lot of wiggle room to lower rates in the event that that unemployment rate does creep up. So we're watching jobless claims very, very closely. We've seen them creep up. They certainly did last week. But again, every day it seems like we're holding on for dear life in this market, where you have a lot of news coming out of Washington, D.C. and from a geopolitical standpoint, but we also are coming out of earnings that were generally strong. And now we come up against some seasonal headwinds in March. So this is a very tactical wait and see market, and the rubber's hitting the road on tariffs. We'll see how that plays out tomorrow, John.
One other thing I just wanted to let our audience know is that corrections, which are defined as a decline of 10% or more without going beyond 20%, let's say. If we're looking at the S&P 5, I mean, I know a lot of stocks have corrected, particularly in technology, but the S&P 500 off its recent peak, I think it's down like 3%. But Ned Davis Research went back, looked since 1928, and every, call it 1.1 years, you do tend to see a correction in the market. So you could even make the argument that bull markets have corrections, and we actually have gone a pretty long stretch here without seeing something substantial on the downside. Should you be scared of corrections, in other words?
Well, again, I'd note back to the sentiment in the market is very bearish, extremely bearish. In some parts of the market, extremely oversold. And so investors have that as an opportunity, specifically folks that missed out on that AI wave or that AI enthusiasm, to plant a flag in the sand, and some of those names that are now down, as you said, John, 5-10+%. But at the market level, you're right. Looking underneath the hood, the market hasn't sold off enough for us to be really in panic mode. If anything, we're seeing this as an opportunity to buy, given the fact that the data is still strong, earnings were robust, the Fed put is in place, And again, the Trump administration is looking to negotiate, and we'll see how that plays out this week and over the next couple of weeks as well.
Okay. Helpful context. We'll be watching very closely. Thanks very much, Alonso.